We've done two of the big equipment names. Applied Materials was breadth. It touches every step. Lam Research was depth, the etch monopoly. Today's company is something even rarer. It's just the monopoly. KLA. It owns something like 58 to 60% of one critical corner of the chip world, and it might be the highest quality business in this entire series.
Its corner is process control, inspection, and metrology. In plain English, KLA is the company that looks at the wafers and tells you whether they're any good. And here's the kicker. You physically cannot ramp a new chip or build an HBM stack without KLA's tools telling you where the defects are. It's the yield Tollbooth, and it ripped almost 7% with the rest of the complex. Let's take it apart. Disclaimer first. One small thing up front. We genuinely love these companies as stories, but we're explaining them, not recommending them.
So treat all of this as food for your own thinking, not financial advice. Stay curious, stay a little skeptical, and make your own calls.
Quick and clear. Education and entertainment only, not investment advice. KLA is a public example to teach this layer, never a recommendation. No buy or sell calls, no price targets. One extra note here. The sources genuinely disagree on KLA's exact share price, probably because of a stock split. So we'll talk about the multiple around 50 times earnings, which is consistent, and skip the per share number. Verify everything live.
The one-liner for KLA, it's the insurance and the toll booth of chip making. A near monopoly with the best margins and the lowest cyclicality in the equipment world, priced like the quality compounder it is.
And those three pieces are the whole story. Near monopoly, almost 60% share. Best margins, gross margins around 62%, the highest in the equipment industry. And lowest cyclicality, because, as we'll see, KLA gets paid even in years when the fabs aren't building much. The catch, as always, is that last phrase, priced like it. Here's why KLA belongs in a memory expansion series. Doubling memory output isn't only an etch and deposition problem, it's a yield problem. And yield is KLA's monopoly. As memory gets denser and goes three-dimensional, the defects that kill your yield get smaller and harder to find. So the amount of KLA inspection you need per wafer rises every single generation.
And high bandwidth memory makes that brutal. You're stacking known good dies into a tower, and a single bad die scraps the whole expensive HBM module. So you have to inspect obsessively. KLA's advanced packaging inspection business surged something like 70% year on year, and KLA is the clear #1 there. The point. Every incremental HBM wafer needs more KLA, and KLA gets paid no matter which memory maker wins the race. The history is a tidy origin story. Two companies in the mid-1970s, KLA Instruments, founded in 1975 by Ken Levy and Bob Anderson, doing yield management, and Tencor Instruments, doing inspection and metrology. For 2 decades, they were the two leaders of the same niche.
Then the defining event. In 1997, they merged into KLA Tencor, combining inspection and metrology into one dominant process control franchise. They rebranded to just KLA in 2019 as the scope broadened into packaging and software. And under longtime CEO Rick Wallace, the doctrine has been simple and relentless. Own yield, monetize the installed base, compound the cash. 25 years of entrenchment in a business where the leader's data advantage only grows. Functionally, KLA is the eyes of the fab. Inspection, finding and classifying defects on wafers and on the photomasks, the stencils used in lithography. Metrology, measuring film thickness, critical dimensions, and whether the layers line up. And advanced packaging inspection, catching defects in the HBM stacks, the bumps, the through-silicon vias.
Plus, a big services and software business, most of it under contract. And that mix matters. When more than 75% of your service revenue is contracted, you have a recurring annuity that keeps paying right through a downturn. So KLA isn't just selling tools, it's selling an ongoing subscription to not flying blind.
And one underappreciated piece is mask or reticle inspection, keeping the photomasks that lithography prints from defect-free. A single flaw on a mask repeats onto every wafer it prints, so one tiny mask defect can ruin millions of dollars of production. KLA dominates that too. It's a perfect example of how yield control isn't a single product. It's a web of checkpoints across the whole fab, and KLA happens to sit on most of them.
The technology spans optical inspection for high-throughput defect hunting and electron beam inspection for the sub-nanometer defects that optics simply can't see, catching electrical defects by voltage contrast, plus the metrology suite that keeps a process in spec.
But here's the deepest part of the moat, and it's easy to miss: the data. KLA has decades of defect signature data and the algorithms trained on it. So its tools don't just see a defect, they classify it and feed the correction back into the process. That data and machine learning loop compounds. More tools in the field means more data, which means better classification, which sells more tools. It's a flywheel a competitor can't simply buy. Run the 3-question screen, and KLA scores the highest of the 3. Question 1. Real bottleneck? This is the strongest moat in the group after ASML. Near 60% share, 62% gross margins, that is enormous pricing power, plus the data flywheel. Yield is non-negotiable. You cannot run a fab blind.
Question 2. Does the next generation help or hurt? It helps the most of any name we've covered. Smaller nodes, 3D structures, HBM, and packaging all mean more. Smaller, harder to find defects. So process control intensity, the KLA dollars per wafer, rises faster than the equipment market overall. KLA's opportunity actually grows faster than WFE. And question 3, can customers keep paying? It still rides the CapEx cycle, but it's the least exposed of the 3 because that intensity rises even in flat years, and the contracted services cushion it. The numbers behind the move. A record quarter of around $3.4 billion, up about 11%, with that industry-leading gross margin near 62%. The split is roughly 60% foundry and logic, 40% memory.
And the structural growth leg is advanced packaging, the AI and HBM inspection. That was around $925 million in 2025, up roughly 70%, guided over $1 billion in 2026, growing faster than KLA's core business into a $9 to $10 billion opportunity it's capturing. That's the cleanest HBM yield lever in the whole group. Stacks can't ship if you can't certify them.
And put the scale in context. KLA is now running at something north of $13.5 billion a year. For a company that does only process control, no etch, no deposition, no lithography, to be that large tells you how essential the function has become. Inspection used to be an afterthought in the corner of the fab. AI complexity has quietly turned it into a load-bearing wall.
Let's sit on that intensity idea, because it's the whole bull case in one sentence. Even if the number of wafers a fab makes stays flat, the KLA dollars per fab go up every node, because each generation needs more inspection steps, more measurement, more electron beam review. So KLA can grow even when the cycle is sideways.
Which is exactly why people call it the quality compounder of the group. It's a cyclical business that behaves, in the middle of the cycle, more like a structural grower. That's a rare and valuable shape, and a big part of why it earns a premium. On structure, KLA is the most monopolistic name we've covered, except ASML. Number 1 in process control at that 58 to 60% share. The number 2s are distant. Applied Materials has an electron beam effort, and there are metrology niche players like Onto, Camtek, and Nova nibbling at packaging. But no one is close in the integrated inspection plus metrology plus software stack.
Compared to the trio, KLA is the most monopolistic, the highest margin, 62% versus around 49% for Applied and Lam, and the least cyclical. The trade-off is that it's smaller, around $13.5 billion in revenue versus Applied's 28%. And it doesn't touch deposition, etch, or lithography. So in an absolute mega cycle, Applied has more raw dollars of upside. KLA has more quality.
And that smaller size is a subtle double edge worth naming. On one hand, a single segment means KLA misses some of the raw dollar upside when deposition and etch budgets explode. On the other, it means KLA is pure. You're getting the monopoly directly, undiluted by lower margin businesses. With Applied, you get breadth and a little dilution. With KLA, you get concentration in the single best margin niche in the industry. Neither is better. They're different shapes for different appetites.
A real risk to flag, though, customer concentration, and it's rising. KLA co-designs with TSMC, Samsung, Intel, Micron, and SK Hynix. And in a recent quarter, a single customer was around 23% of revenue, up from 14%. So a CapEx pause from one of the giants, a TSMC or a Samsung, would genuinely sting a quarter.
It's the same double-edged sword we keep meeting in this layer. The handful of mega customers funding the boom are also the handful whose timing can swing the results. Concentration is the bull case, and the bear case wearing the same coat. And at KLA, it's been getting a little more concentrated, not less. Now a place where KLA is actually advantaged versus its peers. China. KLA's China revenue has fallen from around 41% a couple of years ago toward the mid-20s, and the export control headwind is sized at only around $350 million, materially smaller than Lam, which we said could have 30+% of revenue at risk, and even smaller than Applied.
So China is the least acute risk for KLA of the three. It's real. The structural decline is happening, but KLA redirected toward Korea and Taiwan, and it simply has less exposure to lose. In a world where the China question is the scariest variable in this whole layer, having the least of it is a genuine quality differentiator.
And it's worth connecting that straight to the cycle risk. The names with the most China exposure, Lam especially, carry a policy risk that can step change overnight on a single regulatory headline. KLA's lighter China book means fewer of those landmines. So when you stack the three side by side, KLA isn't only the highest margin and least cyclical, it's also the one with the least political tail risk. That's quality on three different axes at once, which is exactly why the market awards it the richest multiple.
The financials read like a quality compounder, not a boom-bust cyclical. That record quarterly revenue, the 62% gross margin, strong free cash flow. And the tell that I love, KLA has raised its dividends 17 years in a row. In cyclical semiconductors, a 17-year dividend streak is rare. It's a company telling you it's confident in the trough, not just the peak.
Add a fresh $7 billion buyback authorization and more than 90% of free cash flow returned to shareholders, and you get the picture. KLA behaves like a cash compounding monopoly. The capital return record is, itself, evidence of the durability of the moat. You can't sustain a 17-year dividend streak on a fragile business.
And now the honest counterweight, because it's the same one every time. Valuation. KLA trades around 50 times earnings, well above its historical range in the low to mid-20s, and the stock ripped almost 7% with the complex into an overbought chart.
Here's the nuanced part, though. KLA arguably deserves the highest multiple of the three. Best margins, lowest cyclicality, the widest moat after ASML. The problem isn't quality, it's the entry multiple. Even a low beta monopoly is still a cyclical monopoly, and 50 times leaves very little room if the equipment market hits an air pocket or memory overbuilds in 2027. So the question for KLA was never, is it a great business? It's what multiple are you paying for greatness at this point in the cycle? We're not answering that for you, just naming it clearly. So let's rank the trio, because together they make a clean map. KLA is highest quality, lowest beta, the monopoly, the best margins, the least cyclical, the least China, the one you'd be most willing to own through the whole cycle. Applied is breadth and the steadiest broad growth. And Lam is the highest octane, purest memory lever with the most China risk.
For who helps the memory makers expand with the most durable economics, KLA is the quality answer. It gets paid on yield no matter who wins, and its intensity rises with every step up in complexity. The honest tension is just that it's priced like the best business it is. We don't predict. We test the thesis as the evidence lands. Next episode, we leave the fab entirely and move to the back end, the test duopoly, Advantest and Teradyne, the companies that decide whether the finished chip actually works. Thanks for spending part of your day with us, and tell us, of breadth, depth, and the monopoly, which moat would you rather own? Okay, that's our episode. The honest goal here is simple. Hold a few ideas about the world and keep checking whether they're still true.
Together, out loud, a little at a time. If you spot where we've got it wrong, please tell us. That's how this gets better. See you next time.